Welcome to the deep dive. Today we're exploring an idea in finance that feels, well, really counterintuitive. When doing nothing is the smartest move. We've looked into two foundational texts, John Bogle's Common Sense on Mutual Funds and Benjamin Graham's The Intelligent Investor. Our mission basically is to figure out why patience and discipline often work better than constantly chasing the market. Okay, let's unpack this.
Yeah, it's quite something how both of these investing giants, writing decades apart, really landed on the same core idea. Graham, for instance, he famously saw the market like a pendulum,
Mm-hmm.
you know, swinging between unsustainable optimism and then unjustified
All
pessimism.
right, the pendulum.
Exactly. And he believed the smart investor, the intelligent investor, acts like a realist. You buy from the pessimists, sell to the optimists. But what's really striking is his direct warning. He says the average investor just cannot deal successfully with price movements by endeavoring to forecast them,
So don't even try to predict.
pretty much. Instead, he advises, well, basically, he says, resist buying right after a big jump or selling immediately after a steep fall. Don't chase the swings.
That pendulum image is powerful, but what makes it so hard then? Why do we find it so tough to just sit still? Is it just emotion driving us? Because it really feels like that constant need to do something in the market is maybe your biggest enemy. Bogle's work seems to hit this hard.
Oh, definitely. Bogle shows how mutual fund investors often get caught in these consistently counterproductive investment patterns. Lots of buying and selling, high turnover.
Okay, counterproductive patterns.
Yeah, and here's where it gets, well, really eye-opening. Bogle found that mutual fund managers themselves, back in 1997, had average turnover rates of 85%.
85%, wow.
I know. It means they were holding stocks for, like, just slightly over a year on average. This kind of rapid-fire trading isn't free, right? It loads investors up with huge transaction costs and, frankly, staggering tax bills. They eat into your returns before you even see them.
And those costs, they seem small maybe, 1% here, 0.5% there, but they really add up. That's the tyranny of compounding Bogle talks about.
Exactly right. The sources make it crystal clear. Costs are huge. Think about this.
Oh.
The lowest cost equity funds might have an expense ratio of just, say, 0.2% a year.
Okay, very low.
Right. But the industry average, more like 1.5%.
Mm.
Some funds go up to 2.2%. And then you add hidden portfolio transaction costs, maybe another 0.5 to 1%, sometimes more. This aggregate fiscal drag, all these costs together, can easily top 3% per year.
30%.
Yeah. Imagine you get a 10% return.
Yeah.
Almost a third of it could just vanish into fees and costs. That's the tyranny Bogle means. Tiny differences in costs over time lead to, well, staggering differences in how much money you end up with.
Okay, so with all that, the high turnover, the costs eating away,
Yeah.
it suddenly makes perfect sense why doing nothing, a simple long-term approach could be the smartest thing. And we've heard legends say this, right? Peter Lynch said, most investors would be better off in an index fund. Charles Schwab noted only about 1 in 4 equity funds actually beat the market, making him a firm believer in the power of indexing. And Graham himself suggested the ideal choice for most investors is a total stock market index fund. Low cost, holds everything, it seems. Almost too simple.
It does feel simple, doesn't it?
Mm-hmm.
And that's its strength. These passive index funds, they're automatically tax efficient because they barely trade. Low turnover means fewer capital gains taxes compared to active funds constantly buying and selling. Plus, there's this really powerful pattern called reversion to the mean.
Reversion to the mean.
Yeah, think of it like things tending back to average. A fund that has an amazing year. Statistically, it's more likely to do just okay or even poorly the next year, not repeat the stellar performance. So try to pick last year's winner. The data shows it's mostly a losing game long term. Like Bogle said, time is your friend, impulse is your enemy.
So the message from these experts is clear. Sometimes the smartest move, the most sophisticated move, is actually no move at all. Patience, discipline, ignore the daily noise. Just think about the emotional energy and the actual money you could save by just embracing that simplicity.
Which does make you wonder, doesn't it? If success in investing really hinges so much on, well, inaction and tuning out the noise.
Yeah.
What does that say about the financial advice industry itself? An industry often built on encouraging you to constantly do something.